All right, so while we talk about this Harvard, or while they talk about this Harvard thing, let's do a quick note on J.D. Vance and Trump, what they're saying about the Federal Reserve right now. J.D. Vance is apparently arguing that, quote, the refusal by the Fed to cut rates is monetary malpractice. On top of that, on Truth Social, Donald Trump just wrote, CPI just out. Great numbers. Fed should lower 1 full point. Would pay much less interest on debt coming due. So important. I think this is where it's worth just taking a moment to talk about the Federal Reserve, what's likely and what the market is pricing in. Let's just go ahead and start by talking about what the implications of this are, what's likely, and just give you a bottom line on that. And then I'll also give you market pricing. So that way we can kind of see how market pricing has moved and what markets are pricing in. So first things first, remember that the president and the vice president are, of course, going to always advocate for lower rates because it's popular. It is exactly what consumers want to hear. It's what we want to hear as small business owners or medium business owners or employees at large businesses. Everybody wants lower rates on your cars, lower rates for home mortgages. Obvious. So it's a popular thing to say. The question is this going to have any influence on the Federal Reserve? And the answer to that is likely a big fat no, because the Federal Reserve, at least as they say, whether or not we believe it comes with an asterisk, but they say they're going to act apolitically. Now, what is that actually going to mean in this environment? Well, it likely means that we're going to see a delay in when the Federal Reserve is going to do anything. I think the absolute earliest, and this is my opinion, that we see the Fed do anything is September. And the reason for that is when we get into September, the meeting's towards the end of the month, we're going to have inflationary data for not only what we just got May, but we'll also have June, July, and August. We will literally have 3 more full months of inflation data. And if we reiterate the trend we're on right now, yes, in my opinion, we could set up for either a 25 or 50 basis point cut in September. We might actually get a full 1% cut like Trump is clamoring for by the end of the year, if we also, by September, start seeing a weakening jobs market. We're going to have June, July, and August data, another 3 full months of data where tariffs are in place, especially at this higher level that is now an agreement between China and the United States, 55% on China, 10% on the US from China. These are bigger levels than we've had to deal with before, substantial. It was basically a doubling on tariffs that we've had previously on China. So toys, furniture, apparel, these are all going to show up in margin, which could show up in weaker pricing at corporations, and again, therefore layoffs. And so the Fed will look at that data. But beyond this, we'll also get through a very weird environment in markets where you have to get through what's called the seasonality of unemployment claims. Historically, if you look at unemployment claims in the summer, I personally think teachers have something to do with it. Teachers sort of are not working in the summer, but not entirely sure on that one. But there's some seasonal spike you see in unemployment claims in the summer, and they start coming down in the end of July, early August. The Fed will basically have a full 6 weeks of unemployment claims data by the time of their September meeting. This is why September is really setting up to be such a big meeting. Now, let's see what the market is pricing in. The market is pricing in a 0% chance of a rate cut for June 18th, a 16.5% chance of a rate cut for July 30th. I think that's highly unlikely because you're literally 1 week away from new jobs and inflation data in August for July. And then you have the September 17th meeting. Markets are only pricing in a 60.4% chance of a cut right now. I actually think there's even a chance of a double cut in September should we start seeing even just a little bit more weakening in the labor market. And remember the video that I did on the Beaver Ridge curve, which I highly encourage you take a look at. I think I called it the Great Donald Trump Economic Reset or something like that. I'll pull up the title for you in a moment, but I encourage you to watch it. It was one of those Blackboard videos where I go through a lot of the data in the studio. It is, quote, the complete economic great reset, Trump and the Fed. And basically what I do is I talk about this economic concept known as the Beaver Ridge curve, where the Beaver Ridge curve is so abnormal right now historically that the only thing that needs to change, the only single thing that needs to change to normalize the curve is a slight uptick in layoffs. And a slight uptick in layoffs is going to rapidly move that curve into its normal environment. And that normal environment would mean an unemployment rate that skyrockets over 5.5% to 6%. And as we usually see, if we get some move like that, we might end up with a recessionary move after that, especially thanks to artificial intelligence and otherwise, where you get longer term unemployed, up over 10% or whatever. Now, in that video, there were some comments where people were saying, oh, but Kevin, the unemployment rate is only low because they're not counting the unemployed workers, all the unemployed workers. Yes, they are. They are just counted in a different place. Once you're unemployed for more than 6 months, you get counted in the 27 weeks unemployed category. It is something that we pay attention to as well. And yes, the 27-week unemployed category is rising. And yes, historically, every time it starts rising, it's a recessionary signal. Does that mean we're definitely going into a recession? No. But if we get anything that is a slight uptick in layoffs, a slight uptick in claims, I think we're setting up for potentially double cut in September, and that money printer is going to come on very rapidly. Now, is that going to be soon enough to stop a recession? Nobody knows. It could already be too late. Maybe it'll be early enough. However, and this is why I talked about a few days ago, this idea that maybe Scott Bessent could end up becoming the Fed chair, I actually think is broadly bullish. Now, people left me comments, Bessent's testifying right now. People left me comments and they're like, oh, but Kevin, the Fed chair is just one of the committee's voting members. Right. But if you minimize the importance of the Fed chair in a manner of saying, well, he's just one of the voters on the board, the FOMC, then you misunderstand how the power structure of the Federal Reserve works. The chairperson is the person who talks to each of the individual members individually and can shape the other person and sort of lobby them to join in their vision of the direction of macro. And if you get somebody like Bessent who wants to look forward and say, hey, we need to prevent this potential recession from coming, whereas Powell's more of a wait for the data to let us know we're in recession, which is somewhat what it feels like we have right now, then you get someone who is more dovish, who drives the Fed towards more rate cuts earlier. That comes with the risk of more inflation, but I personally don't think we have an environment that risks more inflation. Now, in response to that, I get comments of people going, but Kevin, prices are so much higher. Again, it's very important that we don't confuse the nominal level of prices, which of course are higher than 2019, with what an inflation rate is and what the Federal Reserve's mandate is. The Federal Reserve's mandate is not to have low prices. The federal mandate is to keep prices stable. That could mean stable high, unfortunately, just sort of the way it functions. Anyway, going towards the rest of the year, we have about a 49% chance. It looks like we're pricing in, I'll read it this way. We're pricing in 1.26 cuts by October 29th. We're pricing in about 1.92 cuts, so round it to 2 cuts by the end of the year. I actually think it's likely that we might be closer to 4 cuts by the end of the year if some of that data starts turning around. We'll see. And at the moment, at least, when we look at the Treasury market, based on this inflation data we got this morning, 10 years still sitting around 4.43. So it's still, a heavy weight for small and medium-sized businesses. But that 10-2 spread is still only at 48. And really, you're not at shock territory unless that's rising above 50, like what we saw in the dot-com bubble and the Great Recession. And we're just not seeing that yet. So in other words, things are still good until they start turning. Couple follow-up comments here that I just see in the comments. Does the bond market agree? Again, what I read you out with these odds of Fed rate cuts are based on Treasury market curves. Okay, so this is a distillation of the implied overnight rates from the Fed based on Fed futures trading. So yes, the bond market does cater to that. Somebody says, if inflation isn't high, why are stores more empty than the 2020 lockdowns? These are totally unrelated. Store shelves, first of all, being empty could be your perception. That doesn't necessarily mean they're a reality, because store shelves are often based on the levels of inventory stock up or potentially the lack of stock up. They could be based on supply chain modifications because of tariffs. If we look at the Bank of America supply chain indices, we're actually pretty dang loose on supply chains. So it could just be particular delays related to shipments coming from China, thanks to the Liberation Month, where we had substantial delays of shipments. But that is really unrelated from inflation of why shelves are empty. It could be supply chain related. Now, can limited supply chains for a long period of time create inflation? Yes. That's because eventually stores, if you have empty shelves for too long, you could see prices increase for what's left. But that assumes that demand is also rising and will match those prices. Demand in today's environment is not moving up to match how prices how companies would like to price. That's why we talk about corporates having lower pricing power. So let's see here. Replacing power could easily lead to Arthur Burns. Yes, you are right about that. What you're referring to is basically this idea that if you replace Powell with Bessent, you could end up getting a 1970s repeat where you get somebody who's too reactive to the news. I agree with that. I think Powell is doing everything in his power to avoid being an Arthur Burns for a 1970s. We don't want a 1970s. Powell respects Volcker much more, as any person who studies monetary policy agrees. Paul Volcker gained much more respect and credibility than Arthur Burns did. He represented as basically the largest failure of monetary policy. So this is pretty straightforward here. Somebody here says, "Quit blocking for Trump, Kevin." Eye roll emoji. Well, I think if what you're saying is my opinion that interest rates are going to come down by at least 1% because we're trending towards a recession in the labor market, is somehow hitting the pavement for Trump, then I think you're trying to look for something that doesn't exist. I'm looking at this from a monetary policy and economic point of view. I think that Powell is to some extent right to avoid wanting to be an Arthur Burns and waiting for the data. I think, and this is my opinion, that inflation will stay low and that Powell will be late because of that strategy. That doesn't necessarily, because that aligns with sort of what Trump's saying and calling Powell Mr. Too Late, doesn't mean that I'm shilling for Trump. It just means that my opinion is we should be cutting sooner. But I understand why they can't, because they want to be data dependent to avoid the 1970s. My POV would be more of a gamble, because I would be taking the bet that we're not going to see inflation. And you want to cut ahead to minimize the recession. That's different, right? I'm taking an opinion. Powell is waiting for the fact. And that's understandable. And I respect that. And I understand the Federal Reserve doing that. And that's why I'm trying to show you this difference between my opinion, what the Fed is doing, and then, of course, why Trump says what he does, because it's popular. Anyway, hopefully that helps. We're forgetting about the layoffs announced in March, government cutting 770K, which, right. So this is another thing that is worth paying attention to is, yes, coming into September, you start getting some of those, voluntary layoffs at the government where you got basically, through September to go find another job and get paid through September, even if you quit your job. That's true. But those numbers won't actually show up in our unemployment data. Well, they could start showing up earlier, but it's likely you won't actually see those until October.